Ever have that uneasy feeling in the back of your mind when you're managing your investments online? You pick your robo-advisor, set your goals, and watch your money grow, hopefully. But a nagging question might linger: what if the platform itself goes under? Let's face it, traditional brokerages haven't exactly proven invincible. The financial crisis of 2008 is a stark reminder that even established institutions can crumble. So, what about Wealthfront? Should you be worried? Here's the good news: Wealthfront has safeguards in place designed to protect your assets in the unlikely event of a company closure. Let's dive into the nitty-gritty and unpack what would actually happen to your hard-earned cash. Security blanket, SIPC insurance to the rescue. First up, we have SIPC insurance, which stands for Securities Investor Protection Corporation. Think of it as a safety net for your investments. SIPC is an independent, nonprofit organization funded by member firms, including Wealthfront. Here's the key point: SIPC insurance protects your securities, stocks, bonds, ETFs, in case Wealthfront goes belly up. If that scenario unfolds, SIPC would work to return your investments to you, with a coverage limit of $500,000, including a $250,000 limit for cash. Cash considerations: FDIC has your back. Now, let's talk about the cash sitting in your Wealthfront account. This isn't directly invested in the market, so it falls under a different protection scheme, FDIC insurance. The Federal Deposit Insurance Corporation safeguards your cash deposits at member banks. Wealthfront is clever. They don't actually hold your cash themselves. Instead, they sweep it into partner banks. This means your cash is eligible for FDIC insurance, typically covering up to $250,000 per depositor, per insured bank. Wealthfront strategically uses multiple partner banks, so in some cases, your cash could be insured for up to a whopping $8 million. Beyond the basics, account protection measures. SIPC and FDIC insurance provide a solid foundation, but Wealthfront takes additional steps to secure your assets. They segregate client holdings from their own company funds. This means that even if Wealthfront's finances take a nosedive, your investments remain separate and shouldn't be affected. Furthermore, Wealthfront is a registered broker-dealer, which means they're subject to regulations set by the Securities and Exchange Commission, SEC, and the Financial Industry Regulatory Authority, FINRA. These regulatory bodies enforce strict rules regarding investor protection, adding another layer of security. The not-so-sunny side: what isn't covered? While SIPC and FDIC insurance offer significant peace of mind, it's crucial to understand their limitations. Here's what isn't covered. Market fluctuations. Remember, SIPC and FDIC don't shield you from the natural ups and downs of the market. If the overall market takes a tumble, your investments could lose value, regardless of Wealthfront's fate. Account values exceeding coverage limits. If your investment portfolio surpasses the SIPC limit of $500,000, the excess amount might not be fully recoverable. Similarly, for cash deposits, anything exceeding FDIC limits would be subject to a more complex claims process. The likelihood of Wealthfront going under is slim, and the safety measures in place are robust. SIPC and FDIC insurance provide significant protection for your assets. However, it's always wise to stay informed. Regularly monitor your account statements and keep an eye on Wealthfront's financial health. Remember, diversification is key across any investment strategy. Don't rely solely on Wealthfront. Consider spreading your investments across different platforms to further minimize risk. With that said, thanks for watching, and until next time.